In Chapter 6, we're going to be looking at how to prepare financial statements using the worksheet, and we're also going to be learning how to close the books at the end of the accounting period. Hopefully you remember from Chapter 5 that the worksheet is used for journalizing, adjusting entries, preparing financial statements, and we're going to use it for one more thing in Chapter 6, and that's journalizing the closing entries. Let's first begin with a review of our financial statements. Remember, the income statement is always prepared first. It shows two account types, that's the revenues and expenses for the company. The revenues are shown first at the top, followed by the expenses. And keep in mind that you can list the expenses in the order that they're shown in the general ledger or from high to low. In other words, you would list the highest expense first and then the lowest expense last. Next, the net income is calculated by subtracting the total expenses from the revenues. Let's take a look now at our income statement. Here is the income statement, and remember that the account name is always listed first in the title, the name of the statement, and then the date for the month ended or whatever the period is. It could be for the year ended, but these figures are for the month of June. And we can pull those figures really easily from our worksheet. That's one of the reasons that we prepare the worksheet. In the income statement column, we have our revenues, expenses, and net income, which is exactly what we need to complete the income statement. We just bring the revenues over under the revenue heading, and then we name the revenue delivery fees, and the next heading is expenses, and then we simply list all the expenses that are listed on the worksheet, and these are listed in the order they appear on the general ledger. We just total those and bring the total over to the right side so that it's lined up right underneath the revenue, and then subtract the two figures to come up with the net income. And remember, the net income flows over to the statement of owner's equity, which we'll look at next. The statement of owner's equity is the statement that shows the owner's investment. It tells the owner whether his investment has increased or decreased. The beginning of the statement starts with the capital account, but we can't assume that the figure from the worksheet is actually the beginning capital. If the owner made any additional investments, the only way we would know that is to look at the general ledger capital account to make sure. Remember, over in the left-hand column, we've got the net income or the net loss from the income statement, and then we're going to enter the drawing to show how much was withdrawn from the company by the owner. Let's look at the statement now. Mitchell started his business in June, so his beginning capital is $0. He made an investment during the month of $5,000, so his total investment is $5,000. Now, if we looked at our worksheet with Mitchell's information, the capital balance would have $5,000. The only way we would know that if it started with a 0 and he made an additional investment of $5,000 is by going to the general ledger and looking at the capital account. And that way, for the month of June, we would see that he had 0 in his capital account and he made an investment of $5,000. So it's really important not to assume that $5,000 was actually the beginning balance. and you'll be given some hints in your assignments as to what the beginning balance was. Let's move to the next slide to look at that. Here is an example for Ramon Balboa, his capital. On the worksheet, his capital will be shown at $8,000. But if we go back and examine the general ledger capital account, we'll see that his actual beginning balance was $5,000 and he made an additional investment of $3,000. And so for the beginning capital, we'll list $5,000, and then his investment will be $3,000 to get to his total investment of $8,000. Next, we'll look at the classified balance sheet. The balance sheet is now classified because we're going to classify our assets between current and long-term, which is our property, plant, and equipment. And we're also going to classify our liabilities, which we're going to break those down between current and long-term. Current assets are those that can be converted into cash or used up within a year. So for example, cash is our most current asset. We use that daily. Accounts receivable should be satisfied within 30 days, so that's definitely within a year. We use up our supplies usually on a weekly or monthly basis. And prepaid insurance and other prepaid expenses are typically used up on a monthly basis. Now, property, plant, and equipment are those assets that we've purchased that we're going to use from year to year. Examples are land, buildings, and equipment. Typically, it's the items or the assets that we depreciate. Of course, land is not used up or consumed, so it does not get depreciated, but buildings and equipment, furniture, those types of assets are depreciated because they are used for more than 1 year. Now, liabilities that are current are those that are coming due within 1 year. For example, accounts payable or wages payable. Accounts payable will be usually due in 30 days. Wages payable is, we just put that as an adjusting entry at the end of the year because we're going to pay that in a couple of days. So those are examples of our current liabilities. Our long-term liabilities are those that are going to extend beyond a year. We call that long-term debt. And one of the most often seen examples of long-term debt are mortgages. Mortgages can be 10, 15, sometimes 30 years. And when we prepare our balance sheet, we're going to have 2 headings under the asset heading now. Current assets, and then property, plant, and equipment for our long-term assets. Under our liabilities, we're going to list our current liabilities and any long-term liabilities if there are any. We don't have a lot of those in our assignments. You will see those in the next class, but we don't deal with those very much here in Accounting 1100. And then under owner's equity, we're still going to have our owner's capital, which shows the ending balance that came from the statement of owner's equity. And remember, your balance sheet has to balance. So assets have to equal liabilities plus the owner's equity. And just by using our worksheet, we can complete the statement of owner's equity and the balance sheet. We'll start with the statement of owner's equity. Remember, once we determine whether or not we have an additional investment by looking at the capital account, we can pull the net income directly from here, from the worksheet, because the difference between the two figures equals our net income. And then, of course, the drawing is listed up here by itself. Now, the balance sheet, we're just going to move the figures over to the balance sheet as they sit, all except for the capital account. Now let's take a look at these because we've added a few accounts since we started Chapter 4. Under Assets, we've got two headings, Current Assets and Property, Plant, and Equipment. You can easily identify your current assets. Just start with cash and go down until you hit a piece of equipment or land or something that's long-term, anything that's depreciated. So from here I can tell cash, accounts receivable, supplies, and prepaid insurance are my current assets. So I'm going to list those in the left-hand column and total them over in the right. The next heading under assets is property, plant, and equipment. So that's where we're going to now pull our fixed assets from the worksheet. So delivery equipment, remember, is always listed at its historical value or its cost, which was $4,800. Directly underneath it, I'm going to list the accumulated depreciation for the delivery equipment. Then I'm going to subtract it from the delivery equipment figure to come up with the book value. Remember, the cost minus the accumulated depreciation is the book value. So the cost and the accumulated depreciation are listed on the left-hand side. The book value is listed on the right-hand side and added to the current asset total. So when we add up our assets here, we get $89.40. Now we'll go to the liability section. We only have current liabilities listed here because we don't have any long-term. We've got accounts payable and wages payable as our current liabilities. We'll list those in the left-hand column and total them over in the right-hand. And then the owner's capital. We can't pull the capital figure directly from the worksheet because this is an old and outdated figure. Remember, we updated that with the statement of owner's equity. So we know that the ending capital is $66.40. Another way you can calculate that if you're not given your statement of owner's equity is to take the beginning capital, add the net income, subtract the drawing, and you'll end up with your ending capital balance. So when we add that ending capital to the current liabilities, we'll get total liabilities and owner's equity of $89.40, which equals our total assets. Now we'll start with our closing process. The closing process is the last step in the accounting cycle, which means that we have completed our fiscal year and now we're going to close out the books and start a new fiscal year. When we say close the books, we mean we are going to give some accounts zero balances so that we can start counting those the figures in those accounts again over the next fiscal year. And then some accounts are just going to remain open and we're going to just transfer those balances over to the new accounting period. Now the permanent accounts are the ones that we're going to transfer over to the new accounting period. Those are the ones that are on the balance sheet. So think about the accounts on the balance sheet. We've got cash. We don't zero out our checking account at the end of the year. We just carry the balance over. Accounts receivable. We're going to maintain that customer account on our books. We're not going to zero it out and tell them that they don't owe us money. We're going to carry it over. Liabilities are also permanent accounts. So accounts payable and wages payable, those figures are going to be carried over to the next accounting period along with capital. Of course, any assets we own, like land or equipment, those values are going to be carried over to the next period. Temporary accounts, however, will be given zero balances, and those are the balances from the income statement or the income statement accounts. we're going to zero out our revenues and then start counting them again in the next fiscal year. Same with expenses, and then we also close the drawing account. So permanent accounts are assets, liabilities, and capital. Temporary accounts are revenues, expenses, and drawing. And you'll see these three accounts in the closing process that we're about to look at. Now, before we start the closing process, there's a new account we're going to use that's going to help us in that process. It's called the income summary account. And it is just a very, very temporary account that we open up just to put our revenues and expenses in just for a short period of time before we close them out to the capital account. So income summary is not going to appear on any financial statement. It's just going to be with us just through the closing process. In the closing process, there are 4 closing entries, and I did a little mnemonic here to help you remember those 4, R-E-N-D. So the first step is to close the revenue account, and thus the R. So all the revenues are closed to the income summary account. Now, revenues are normal credit balances. So when you look in your general ledger, your revenue will have a credit. In order to close that, we have to debit it for its balance, and that'll bring it to 0. If we debit revenues, we need to have an offsetting credit, and that is our income summary account. The next closing entry is step 2, that is E for expenses. So we're going to close all our expenses, and we have to close them all individually. Expenses have normal debits, so we are going to look at the balance in our expense accounts and give them a credit for whatever their balance is. So since we are crediting these expense accounts, we need an offsetting debit, which will be income summary. The third entry is step 3, and we'll remember that with the N. And the N is for net income. And in this step, we're closing the net income that's left in the income summary. You know, we put in the revenues and we put in the expenses. So when you net those two out, you've got the net income now in income summary. And we're going to take that and close it into the capital account. And we just can't throw the balances away. If we did, our books would be at a balance. So the net amount is transferred into the capital, and remember that's either the net income or net loss, and that is used in the calculation of the ending capital. So if we have a credit balance in the income summary account, we know we have a net income, and we're going to increase our capital with a credit for net income and then debit income summary to close it. If we have a net loss, we're going to do just the opposite. A loss will decrease our capital, so we would debit owner's capital and credit income summary. And then the fourth step, we've got D, where we're closing the drawing account. So drawing has a normal debit. To close it, we're going to credit it for whatever its balance is, which will give it a 0 balance, and then we will debit owner's capital. So that mnemonic, remember, is R-E-N-D, revenues, expenses, net income, drawing. And we can accomplish those 4 closing entries by looking at our worksheet. And most of the figures that we need are going to be in this income statement column because that's where the temporary accounts are. So remember, the first step is R, revenues. It has a credit balance. To close it, we would debit revenues and credit income summary. Our expense accounts are next. They all have debit balances. In order to close those, I'm going to have to credit wages expenses or wage expense for $20.50, rent expense for $1,000, supplies expense $60, and so forth. So we're going to credit those, total them up, and then debit income summary for their total. The third entry is to close net income to the capital. Now I can see here that I have got a greater revenue than I do an expense total. So I know I have a net income here. So I am going to increase my capital with that net income with a credit and debit income summary. So that's 3 of our 4 closing entries taken directly from the income statement column of the worksheet. For the 4th, the D, closing the drawing, we'll just find the drawing balance on the balance sheet column, give it a credit to zero it out, and then debit capital. So the drawing account is closed directly to the capital because we closed out the income summary account in step 3. Right, this is what those entries will look like in your journal. Just like when we did adjusting entries, we're going to enter closing in the description here. And here is the revenue that we closed. We debited it. So when we post this debit to our general ledger, delivery fees will go to 0. And then income summary will have a credit of $8,000. Once we complete the second step, which is closing the expense accounts, we're giving all of those credit balances. So once these are posted to these accounts, all of them will close out. They'll go to 0. And we can total those up, and instead of doing a bunch of individual small entries, you'll do one compound entry and just put the total in income summary. And now our income summary has a credit of $8,000 and a debit of $33.60, which means its balance is the difference in the two, $46.40. So we have a credit balance of $46.40 in income summary. And we're going to take that and close it to capital. Since our revenues exceeded our expenses, we know we've got a net income, which increases our capital. And to increase capital, we credit it. And then we debit income summary. So if we had a credit of $46.40 in income summary, and now we debit it for that amount, income summary's closed out. So that was a really temporary account. We opened it in step 1 and closed it in step 3. So the drawing, we're closing directly to capital. Drawing had a debit, we're going to credit it, which will give it a 0 balance, and then debit capital, because drawing does reduce the owner's capital. Once we have journalized and posted all our closing entries, we're going to prepare a post-closing trial balance. And that just means it's an after-closing trial balance. And we do this because we want to make sure our debits equal credits as we go into the new fiscal year. Now, we've closed out a lot of our accounts, so the only thing left on the post-closing trial balance are those permanent accounts, which are the balance sheet accounts. Assets, the liabilities, and the capital. So here you'll see the balances that were carried over from the previous year. Here are our assets from cash to delivery equipment, our 2 liabilities, accounts payable and wages payable, and then our capital. And just make sure that the capital is updated and equals what is reported in the statement of owner's equity. And our debits do equal our credits, so we are ready to start the new fiscal year. Now we'll review the steps in the accounting cycle since we finally gotten to the end of it. Remember, we start with analyzing the source documents, and we journalize transactions and then post them over to the general ledger. At the end of the accounting period, we're going to prepare a trial balance to make sure debits equal credits, and we're going to look at some of those balances to determine which ones need to be adjusted. And we're going to enter those adjustments in the adjustment column of the worksheet. Then complete the worksheet by carrying the adjusted trial balance figures over to the income statement and balance sheet columns. We're going to then journalize and post the adjusting entries from the worksheet to the general journal. And then we will prepare the income statement, statement of owner's equity, and the balance sheet for the fiscal year. Next, we'll journalize and post the closing entries using the worksheet. And the last step is preparing that post-closing trial balance.